In this video, we recap some of the main points of the previous few videos on market making and also investigate market making from a high-level business perspective. Seemingly, one of the main factors influencing a market-making firm's profitability is volatility. Generally, trading firms profit from high volatility times. To demonstrate this, consider this chart showcasing Flow Traders' net profit between 2015 and 2023. Overlaid with the S&P 500 Volatility Index, also known as VIX. Clearly, we can see that these two seem to be highly related. 2020 was a year with particularly high volatility with the COVID virus outbreak, and this was also the year in the recent past where Flow Traders' profitability was by far the highest. Recently, volatility has dried up and come quite far down, and we can observe a similar trend in Flow Traders' net profits. We can also observe similar patterns with other trading firms and their profitability in relation to volatility in the markets they are trading. So, there seems to be a relation between volatility and profitability. However, why is this the case? There can be many reasons why this is the case, but we focus on two of the, in our opinion, most important factors. First of all, high volatility is typically strongly related to high volume. Here we can see a scatter plot of SPY's weekly average daily volume and VIX's average weekly closing prices from 2005 up until 2024. There seems to be a high relation between these two factors where high volatility is related to higher volumes. The reason why higher volumes are desirable from market makers' perspectives is simply that means they can trade more and more people cross their spread. Logically, a trading firm would much rather earn the spread 1 million times a day than just 100,000 times a day. A second factor is that during higher volatility times, we generally have higher uncertainty. In other words, it is less clear what a fair value for a given product might be, which implies an increase in risk for market makers, which makes them widen their spreads to account for this risk. This also has a positive effect in terms of profitability for market-making firms, since wider spreads means they can earn more money for each trade compared to a lower volatility time. Further, these two effects of increased volume and increased spreads support each other and lead to much more profit for trading firms. Generally, there's just less competition in relation to the need of liquidity, and trading firms can indirectly charge more for the same service. Note, however, that most trading firms also deploy non-market making strategies, which might also be improved in higher volatility times, since typically there are much more opportunities of small inefficiencies and mispricings in chaotic, highly volatile times than trading firms can take advantage of. That being said, we have now reached the end of this small mini-series on market making. In conclusion, you should now understand the value proposition of market makers. This means you should understand that market makers provide liquidity by matching buyers and sellers and take on risks by doing this. They do this since they can get compensated through the spread that they offer between the bid and ask price that they quote. Further, you should be familiar with the mechanics that the market makers and other trading firms deploy to achieve profitability. Examples of this include hedging, arbitrage, and general risk management. Finally, you should understand the risks and business exposures that market makers need to consider. A big example of this is adverse selection, which is related to their counterparties potentially being more informed than them. Furthermore, market makers need to tighten their spread and give up some of their earning potential through the introduction of competitor market makers. Last but not least, market makers generally achieve highest profitability in times of high volatility due to increased volume and wider spreads. This means the direction that markets go in are much less relevant than the volatility for trading firms. That is also why trading firms often perform very well in market downturns and crashes. They are directionally neutral but can profit from increased volatility during these times and an increased need for liquidity.